I'm down in Tampa today, but Henley's U.S. offices are in Boston.
Great. So,
and I'm calling from Naples in Florida. So the three of us are in Florida, different parts of Florida.
yeah, actually, I'm going for Christmas to Naples. Maybe we should catch, if you won't be traveling elsewhere, maybe it's a chance for us to meet. One of our biggest supporters in our family office community is Silverstein, and they are in Naples a lot, and they keep on telling me you should do a conference in Naples. So I'm going to check it out. Anyways, so today we're going to have a very interesting discussion. I had numerous discussions. None of them dealt with your area, which is very interesting, the car wash industry and the real estate around it. So we will be talking about that. And our topic today is, of course, the opportunity to invest in dynamic and fast-growing express car wash portfolio with a robust projected net returns that you guys see at over 25% plus IRR and 2.5x multiple, accompanied by an 8% annual yield. So we'll talk about that in a second. Couple of words about you guys. You will, of course, explain more. You're with Henley, an international investment and fund management firm. I believe you guys started in England with a focus on private equity real estate, deploying both institutional and private investor capital across the risk return spectrum. Your today's session is, as I've mentioned, about seeking investors to your new venture in the fast-growing and dynamic car wash industry, which we'll be talking about in a second. And my guests today are Ian, who's a Naples seasoned investor and entrepreneur. He's the board chairman of the company with experience across geography and markets, founded and became CEO of Henley in 2006, growing the business into the broad investment business it is today. Prior to Henley, he managed and grew two retail companies between 1996 and 2006, along with a small propco and consultancy business. Ian has a degree in economics and started life in the corporate world with Procter & Gamble, later moving to PepsiCo, where he was the European sales and marketing director. What you guys did with Zero at some point, I don't know if it was in your time, but that was amazing. Garrett Solomon, board member, capital markets and real estate. He led the acquisition, he leads the acquisition, asset management, and disposition activities on properties across multiple assets, classes, and strategies, including car wash, with a total capitalization of over $5 billion. He founded or co-founded two successful real estate operating platforms since 2012, building each operating team from the ground up. He currently serves as the CIO and managing director for Henley's North American platform based in Boston. And here we are. So good morning, and maybe we'll start with a couple of words about you guys that I haven't covered and about Henley. I believe then we'll go to do to see a presentation, and then I have loads of questions, and we'll take it from there.
Perfect. Thanks, Denny. That's great and a very thorough introduction already. And just apologies that I'm not on camera today, people. I'm afraid I'm suffering from some kind of illness at the moment. So as my mother said, I've got a good face for radio anyway. So you'll have to just live with the name, I'm afraid. Anyhow, just very briefly, Henley, as you say, we started back in 2006. We've deployed around about $3 billion of capital to date. We've put that into something like 150, 160 different vehicles. We are multi-strategy in Europe with core strategies through to opportunistic. In the US, we are more value-add and opportunistic driven. We have both a fund business and we raise capital on a deal-by-deal basis. Our fund business is in the core plus space in Europe, and then both in the US and in European value-add and opportunistic. We tend to be deal by deal, but we tend to do JV programmatic activity with large investors, people like Sixth Street, Goldman, Morgan Stanley, for example, have all been investors with Henley at different times. And our return is good on that number of investments that we've made, we have delivered around about a 20 IRR across all investments, and we have delivered about a 1.7 money multiple. So a very solid track record. You know, we're really excited right now. Within the US, we've got two aspects that we're very focused on. We were in multifamily. We managed to sell all of our multifamily kit by the end of last year, and we've been waiting for the market to correct before we go back in. And whilst we've been waiting for that, we've been very focused instead in the US on the car wash space, which is a real, as Garrett will come on to tell us, you know, a huge opportunity, a bit of a hidden gem that more and more people are waking up to, but has a huge amount of potential.
Thank you. Garrett.
Yes, let me share a presentation with folks, and then we'll walk through it. So
Sure.
Hopefully everybody can see this now. And what we're offering today is an opportunity to invest with us in an initial portfolio of 5 different car wash stores that we are acquiring the land for and will be developing. They are all currently in Florida, in the Tampa and Orlando marketplaces. So just ticking through what we'll try to cover today, and I'm not going to read the slides, and these are part of a larger deck that we can share with interested groups after this call. But today we'll hope to cover why we are very interested in investing in the car wash industry, why we think our particular opportunity is the best way to play in the space. We'll talk a little bit about the structure of the investment that we're offering and what the return profile is. And then we can talk a little bit about bits and pieces of the portfolio that are identified and that we are moving forward on transactionally. I think at a very high level, this is a very large and growing industry. We'll get into some of the details. We've got a lot of experience, as Ian referred to, having deployed about $3 billion of capital globally over the last 16 plus years. So we're a trusted sponsor and a good operator of our investments. We've built what we think is a best-in-class team to execute on this opportunity. We've structured this in an interesting way that provides investors a lot of protection, with the sponsor subordinating any participation in the profits, to return of the investors. And the returns here are almost 40%, and north of a 4x at a deal level. And then net to investors in the very high 20s and to 7x. And importantly, there's a cash yield component, which is very desirable. It's certainly even more so in today's environment. And then we'll talk a little bit about our proprietary portfolio and our product and how we go about evaluating sites. So why the car wash industry? So this is a developing and emerging industry. It's actually very difficult to notice how many car washes there are in the country unless you're actually looking for them. There are over 60,000 car washes in the United States, and that is double or more than double the number of McDonald's and Starbucks combined, just to give a sense for scale. So they're everywhere, and once you start looking for them, you will see them. About $22 billion in projected revenue. There are lots of numbers that people throw out in ancillary car wash businesses. Sometimes those numbers are as high as 30 billion, 6% CAGR, so still growing very strongly. There are a number of key players, 2 of which are public. The rest are all private. I believe that there are some of these private players will be going public in the coming years as they grow and scale. And as a result, there's a lot of private equity that is starting to get into the industry. It's internet resistant, it's service-based, low labor model, and high margins is really driving that. And as I said, it's early in terms of the industry consolidation. And then also importantly, the revenue model is subscription-based, or 60 to 70% of the model is subscription-based. So you have a strong recurring revenue model, which mitigates seasonality and bad weather, which can play a part in profitability of car washes. And then just to give some statistics on the side here, in the car wash space, there are really 3 main categories of car washes that people are probably familiar with. There are self-service bays where you'll pull into a little bay and get out of your car, and there'll be a wand, a high pressure wand, and sometimes there's soap and sponges, and you can wash your own car. We'll call those self-service. There are in-bay automatics, most commonly seen at gas stations, where you'll pull into a little booth and the door will close behind you. Your car will be stationary and a machine will go back and forth over your car for 6 to 8 minutes, depending on the level of service you've chosen. And when the process is over, the door in front opens and you pull out. That would be an in-bay automatic or a rollover. And then the third area where we're most focused is a tunnel or conveyor system. And in these car washes, you'll pull up to usually a 100 to 150 foot tunnel. You'll go on to either a belt or a conveyor that will pull your car through the wash process. It usually takes 2 to 3 minutes, so it's much more efficient. Get a lot more volume in, and actually today with the technology, a higher quality of wash. You'll exit the tunnel on the other side. About 50 to 60% of the people will then pull into a self-serve vacuum area and do their own internal cleaning. And the other folks will just drive off, and leave the site. But those are the three main types of car washes, and the conveyor or tunnel car washes is where we're really focused. So speaking about the tunnel portion of the industry, it is the fastest growing component of those three. We think the self-serve car washes, will largely be obsolete, and the in-bay automatics, are just becoming a smaller and smaller share. The quality of the wash is lower, and they're really ancillary to, a gas station or typically another service, as opposed to be the purpose for somebody's visit. The tunnel car washes are very low labor intensity. That can be run with very few employees versus a manual car wash. And that's a driver of the margins. Typically, it's less than 3 minutes a car through the process, and it's the vast majority of the new car washes being built are all express tunnels. So just talking a little bit high level about the industry, there has been a lot of M&A activity and even an IPO last year in June. Where the largest player now is public. There's a second public company that has car wash as a component of its business. And as I mentioned earlier, likely to be a number of other players who do go public in the coming years. So just for sizing purposes, 60,000 plus car washes in the US today. The largest operator, Mr. Car Wash, who did their IPO last June, manages about 400 today. So it's an incredibly fragmented business that is ripe for consolidation. There's a lot of private equity getting into the business as well. Zips was acquired, Driven Brands, which is the second public company, bought International Car Wash Group. Warburg Pincus just bought L Car Wash. Mr. Car Wash is owned by Leonard Green prior to the IPO. So there's a lot of private equity getting into the business, and valuations today are done on an EBITDA basis, a multiple of EBITDA. Using Mr. Car Wash as an example, it went public at a $15 share valuation, valuing the company over $4 billion, which was north of 25 times EBITDA. It actually traded up quite substantially from there. It's traded back off today. It's off about 37% from the IPO price, but is still trading on 2022 projected EBITDA, roughly 15 to 16 times. Our business plan and our model contemplates exiting our car washes at only 12 times. So at a pretty significant discount to where Mr. Car Wash is today, a very substantial discount to where it was at IPO and its peak, and even at a discount to one of the most recent sizable transactions, which was the acquisition of a company called L Car Wash by Warburg Pincus earlier this summer, and that was at roughly an 18.5 times multiple. So thinking about why invest with us in our model, given that there are a number of other operators out there, we've on our team at Henley, including the car wash team that we put together, we have significant retail experience, and a lot of that is with Ian and his wife Emma, who are both retail experts prior to their private equity experience. And our operating team, our team CEO and COO are also very experienced in the retail marketplace with over 10 years of specific automotive retail operating experience. We've been in this car wash space now for almost 4 years ourselves. And we have, in that period of time, purchased and operated and are now disposing of, as part of a different strategy, 12 car wash properties. We're experienced private equity investors. We know how to leverage that experience. We've got a proven track record of working through cycles and different industries. And we feel like we've really built a best-in-class team going forward. So just in terms of the structure of the investment that we're offering here and the return profile, we're raising $19 million in aggregate. This will cover the cost to acquire and develop the first 5 sites. All 5 of those sites are either under contract or under LOI. In fact, we have more than 5 because some of them won't make it through due diligence. But we are through due diligence and getting ready to close in January on our first 2 sites, one of which is in Tampa, one of which is in Orlando. I'll come back to those in a little bit. But that's what the use of proceeds will be for acquisition, development of the sites, with some other third-party financing that we're using to fund the operation of those businesses. And the way that we structured the investment is that investors will receive 100% of all proceeds that are distributed until they've received a full return of their capital and a 10% IRR thereon, and after which there'll be a catch up to the sponsor until we get to 50% of the profits, and then all remaining profits will be split 50-50. And when that results in, based on our underwriting, net returns to investor after the sponsor participation of mid to high 20 IRR, an equity multiple of 2.7, and importantly, a cash on cash component of about 8% average per year over the life of the investment, which we think is 5 years from acquisition of the first site till monetization of the investment. So just talking quickly about the sites that we're working on. As I mentioned before, we're focused initially on Florida and 2 specific target markets in Tampa and Orlando. The first site that we have under contract that will be closing in January is in Tampa on North 56th Street. It's highlighted in blue there on the screen. It's currently a vacant parcel. That's roughly a 1-acre site. We bought it on market for just under $1 million. It's next to a Wendy's and a sandwich shop on a very high traffic road that does roughly 40,000+ vehicles a day. We've developed our own proprietary scoring matrix that looks at probably a collection of 20 to 25 different variables that we think are precursors and predictors of success at the site. And we use this tool to underwrite new opportunities. This site scored very highly, 8.7 out of 10 on that matrix. And we look at all kinds of different variables that range from population density, median incomes, the traffic out front. We look at specifics of the site, its orientation to the road, dimensions. We look at competition. We look at proximity to retail, a whole host of factors. And one of the things, importantly, that we won't do, at least not today, is take any entitlement risk. So each site that we are acquiring is already approved by right for the use of a car wash, and we go through the administrative process of getting our building and our site plan approved, but we're not taking any discretionary entitlement risk on any of the sites. So this is the first one in Tampa, just south of Temple Terrace. Temple Terrace actually is a very affluent suburb of Tampa. Does not allow car washes in Temple Terrace. So we're right outside of Temple Terrace, and we'll be able to capture a lot of the traffic going into Temple Terrace. The second site here that we're sharing with you today is in Orlando on Curry Ford Road. This is a corner site. It's an existing gas station, also just under 1 acre. This one's priced a little bit more robustly at $2.5 million across the street from a Wawa. It does a higher traffic count, about 25% more traffic. It's also scored very high. There's a greater population density, similar incomes, and we'll be closing on this site in mid-January. So just lastly and quickly, to give folks a sense for our product and our brand, Aquasonic is the name that we've developed. And these are some renderings of what the buildings may look like. These are not final, so there'll be some tweaks to these as we go. But for those who are not familiar with an express wash, express car wash, if you can see down here in the bottom right corner of the screen, typically you'll have a number of lanes that come into pay stations that collect the traffic. They'll go through the pay stations, they'll come around, go through the tunnel where the wash occurs. The tunnels are usually 125 to 150 feet. They can typically wash, you can typically wash in an hour, one car for every linear foot of tunnel length. So typically we can do 120 plus cars an hour, depending on, the volume. After the people come out of the wash, they'll have an opportunity to come into a covered vacuum area to do their own internal cleaning of their vehicle if they choose, or they'll be able to exit out of the site. So if you've seen other car washes, this building design is very unique. It's very modern and futuristic, provides an excellent quality of car wash, and we think will be an important part of the brand and the story of Aquasonic as we go forward. So I think just in conclusion, and we'll open it up to answering questions. Again, we touched on why the car wash industry. It's large and it's growing at a very healthy pace. It's very fragmented today. As I mentioned, 60,000 stores in the country, with the largest operator controlling only 400. The economic model today is driven by a subscription revenue component, where roughly 60 to 70% of your revenue on a monthly basis will come from a monthly unlimited wash subscription that users will acquire, and this gives great stability to your cash flows. Otherwise, you could be impacted by weather or other downtime at the properties. But this recurring revenue helps to mitigate that. We talked about all of the institutional capital that's coming into the space, and we really believe that we have a winning strategy, to outperform. And we do think that developing ground up, which is what we're doing, will result in a lower basis than buying existing and renovating, which we think is much more expensive today, and compromises your ability to have a coherent, and consistent brand across products. Just on Henley, as Ian touched on at the beginning, we're a very experienced, investor and sponsor of these types of investments, having invested about $3 billion globally over the last 15 years across industries, geographies, and strategies. We've built a best-in-class team, and we've been in the business, for about 3.5 years. We bought 12 car washes starting in the summer of 2019 through the first quarter of 2020, immediately pre-COVID. That was part of a different strategy that was focused on buying existing and renovating, and the market has evolved very quickly so that that it's less expensive today to buy a piece of land and build, and you get more control over your product, which is why we've had a pivot in the strategy. In terms of the investment structure and the return profile, as I touched on, very substantial returns, with the sponsor subordinating our participation, to a return of capital and a 10% IRR. And then, in the high quality portfolio, we've developed our own proprietary matrix to evaluate sites. I can tell you anecdotally, we're working with the industry's largest equipment supplier, who has presented, lots of sites by potential operators. They reject about 90% of the sites that are presented to them as potential car washes. We've shared with them probably 20 or 30 sites at this point, and they've only had one or two that they've said you might want to think about that one a little further. So our scoring matrix is working to help us identify best-in-class, high-quality sites. All of the sites that we'll be investing into and developing with the capital we're raising here are under contract or LOI at this point, and we have a very robust pipeline of additional sites identified. And we've developed our prototypical site plan and layout, which we then customize, for each site, which I shared with you. So I think those are the highlights. Just a couple other things that I'll mention before we get into Q&A, and Ian may want to add his thoughts here. There are also some unique accelerated depreciation benefits associated with car washes that can provide additional tax losses in the early years for investors to shield other gains to the extent that those exist. So there's been a lot of capital that has come into the industry as a result of that, and that would be the case here as well. And then the only other thing that we didn't cover in detail, and this presentation is just a portion of a deck that we have to share with people who have interest after this call, is that our strategy is to ultimately be an asset light model. So we will not be owning the real estate, at least on these initial stores. We have a sale leaseback agreement with a public REIT who will be acquiring the land and funding the development on our behalf, and then leasing the asset back to us on a 30-year ground lease basis. And so that's an important part of the model. Ian, is there anything you want to add to the overview before we throw it back to Denny for questions?
No, thanks, Garrett. That was very good. I think the only other numbers probably just worth mentioning as people get their minds around this space, if it's new to them, would probably be one that the cost of goods, the cost of chemicals, etc., works out to be around, and utilities works out to be around 10%. So you've got a 90% gross margin business. And not surprisingly, your biggest cost therefore becomes labor thereafter and some marketing. But your EBITDA in this space is, if you're running a good car wash with 250,000 washes a year plus, and 60-70% being members, as Garrett has said, then really you're throwing off a mid-40s EBITDA margin. So I think that's probably an important point, because if you were to compare this to the QSR space, for example, it's materially more profitable.
Great. Thank you guys for this. Loads of questions. What time is it? We have lots of questions come. Oh, we have time. So just a couple of questions before I start with mine. A couple of questions from folks here. So they're asking about inside cleaning option for a higher fee.
Yeah, so in fact, there isn't an additional fee. So the vacuums are free. That's an add-on. It's not an add-on service. It's an additional service that is provided for customers. So I'm still sharing my screen, I believe. So if we just go back to the site layout, you can see that the vacuum area really can't be accessed off the street. It's only for customers who have come through the tunnel. So it would be the sort of finishing touch that you would put on after you do your exterior wash. And you could flow through that parking lot, pull in, and spend as much time as you wanted with the high-powered vacuums. We'll also have some some wipes that are infused with window cleaning solution to clean the interior of your windows. Of course, the very strong and powerful vacuums will have some air pressure hoses that allow you to put some air pressure into your tires, or use them to blow out sand or other things that get into the nooks and crannies in the car. But that is a free service for customers after the wash.
And we wouldn't want to do what's called flex service, which some people have done, where you have staff there who do that cleaning for customers, simply because in having experienced this ourselves, that service doesn't get sufficiently well used. A lot of customers don't like third parties going into their car. They're frightened they're going to take change out of the out of the coffee cup area, or it just leads to a very gray area. So it's something we have looked at, have experimented with within the first 12 stores that we've got. But again, part of the last 3.5 years experience, as we've been building up to get the real, the best execution of car wash, has led us very firmly down the view that you provide the cleaners, but you let customers have the flexibility to do it themselves rather than do it for them.
Couple of other questions. Is the revenue model primarily subscription-based? Can you speak to the recurring revenue model thesis?
Yes. So we think about 60 to 70% of revenue ultimately comes from memberships. And these are, they're called unlimited wash club memberships. So a customer can pay, can come to the site and they can pay to wash on an individual retail basis, or they can pay an unlimited price, a monthly price, and they could wash their cars every day if they chose for one fixed price. Our industry research says to us that about, again, 60 to 70% of your revenue volume is from members, and that the average length of membership tends to be about 12 months, so it is very sticky. We are quite experienced in crafting programs, membership drive and incentive programs to grow membership base at these stores. So we're very comfortable that we can achieve very high membership numbers. And an average, to give you a statistic, an average member washes their car somewhere between 3 to 3.5 times a month versus a retail customer who might wash their car twice a year. So those members, thinking about it on a cash basis, and we'll just pick the lowest wash category, because we'll have different tiers of membership and different tiers of service. But if your lowest, just for argument's sake, is $10 to make the math work, and your for that same class of service, the monthly cost is $20. A monthly customer, a member customer, will be paying you $240 a year versus a retail customer who might pay you $20 a year, washing twice a year. So it's very important to get memberships, and it also stabilizes, as I mentioned earlier, your cash flows. So you're not impacted by bouts of bad weather. If it rains for a week, people don't typically wash their cars when it's raining. Nature does it for them. So you don't have these as big fluctuations in your revenue with a subscription-based revenue model.
Another question I see here is about the management team. If you can talk about that, we'll be running the washes once they're online.
Yeah, so we've built a corporate team here in Florida with great automotive retail experience. Bill Berkins is the gentleman who is the CEO of the business today. He used to run Big O Tire and Midas, so a lot of automotive retail experience, and he's built a team around him with a COO. And as these stores get closer to opening, we'll be building out the rest of both the store level team and the corporate team. And of course, that team has also operated our existing portfolio, so they're not new to the industry at this point.
And another question I see, and by the way, guys, this is recorded, so we'll send you this later on, and including the contact information for the folks at Henley, so you can ask specific questions later on. So I'll just ask this: somebody just wants a clarification. If your REIT partner pays the capital cost of building out each location and takes the risks of construction cost overruns and delays?
Yeah, so it's a bit of a hybrid. So the REIT partner will fund 100% of the cost of the land and the development of the building, subject to a budget. So, and they'll fund 110% of the projected costs of the land and building. So we have a 10% contingency built into our cost estimate. And then we would be responsible for any additional costs over and above that on the land and building. And then separately, the last component is the equipment package that goes into the tunnel and around the site, the POS system, the camera system, and then all the tunnel wash equipments and the vacuums in the vacuum area. That's roughly, another component that we'll finance with a traditional equipment finance partner. We haven't finalized who we're going to work with yet. We're still exploring and making sure we have the best possible option there, but that will be financed separately. So in essence, very high level, roughly an $8 million cost per site, $2 million for land, $3 to 4 million for equipment, and $3 to 4 million for the development of the building and all the site work, and then $2 million for the equipment.
Got it. If you can get out of the screen share, that would be great, because I'll ask you a couple of questions. How important is owning the real estate when valuing a car wash?
You know, it's definitely helpful, and we think there is a premium that is paid or a premium that's attributed to the value of the company if you own your real estate. It's really option value. The vast majority of transactions we're seeing today in the marketplace are all financed by sale leasebacks. So when Mr. Car Wash goes out and buys up, 10 car washes in Texas that it's buying from a local operator and expands its footprint, it is typically immediately after sale, if not contemporaneously, doing a sale leaseback. So it is owning, the industry is owning less and less of its real estate. And it's not dissimilar from QSR and convenience stores and pharmacies and, other single tenant net lease, operators. That said, we do think that there could be a slight premium if you own your real estate when you go to exit, because that provides an opportunity for somebody to effectively have built-in financing if they were to acquire you. And that actually leads to an interesting point, because we didn't talk about how we're exiting the space. We talked about how we're building a portfolio. Our plan is to build 100 plus of these across the US in the next 5 to 7 years. So the opportunity that we're talking about here today is on the first 5. And we believe that we'll be able to either exit one of 2 ways at the end of that 5-year hold period. The first would be if we get enough size and scale ourselves, we could go public, and it could be a public exit. The other alternative would be one of the larger participants in the market would acquire us and roll us into their platform. So those are the 2 alternative means of exit and investment realization at this point.
And why Florida?
Well, there are a couple reasons. I mean, first and foremost, it's just such a dynamic economy right now. Lots of people moving into the state. It's the 3rd most populous state in the country, behind Texas and California, but surprisingly has the highest number of cars per capita. So for a car wash business, that's that's an important factor. The climate is very business friendly. There's availability of land at a reasonable price. Some of the car washes that we've owned historically have been in the Northeast, where land is far more scarce. So your basis is much higher. It changes the risk profile of the investment. Your costs are higher. So for a whole host of reasons, we've chosen to locate and start in Southeast in Florida, in Tampa and Orlando, and then we'll be going north and west up the East Coast, and then further to the west, Texas and the mountain states. Phoenix is probably the most densely populated, operated market in the US for car washes today. So it's probably a market that we'll look to avoid. And California has a lot of regulatory and other challenges that make that a difficult place to operate. But with the exception of those 2 areas, we're looking for population density, people who have an interest in maintaining their cars. There are more cars on the road today than there ever have been in the past. And for a lot of folks, their car is their most valuable asset. And we believe that washing your car on a regular basis is part of a maintenance program. It prolongs the life of the vehicle and the value of the vehicle.
Are you taking any entitlement risk with your land purchases?
No, it's a great question. And the answer is no. Every parcel that we have under contract to acquire allows by right the use of a car wash. So we are not taking any risk that we are buying something that is residentially zoned and we have to go change the zoning. That's a risk that we don't want to take and don't need to take. The process when we buy these sites, because most of them are vacant, as you could see from the pictures, the North 56 site in Tampa is a vacant lot. We'll have to do a site plan approval there and then just pull a building permit. But the underlying use of a car wash is permitted by right in the zoning classification for the sites that we're acquiring.
Another question, what type of due diligence do you undertake on your sites that you acquire?
Yeah, we do the whole traditional basket of real estate due diligence. So we're looking at title and survey. We're looking at the entitlements, of course, and the permitted uses. We're doing a full environmental review to make sure that the sites are clean. We're looking at utility availability. We evaluate the competition in the marketplace. We look at access, to the sites to the extent that there are any extraordinary development costs associated with it, wetlands, endangered species, all of those types of things. So it's a very robust institutional approach to due diligence, even though these are, in the grand scheme of things, relatively small, $1 to $2 million on average acquisitions of vacant land. We have a very institutional and robust diligence process.
The environmental side, how that comes into place with your product and design?
That's another great question. So, and I'm going to use some high-level numbers here, but typically people who wash their car in their driveway will use 100+ gallons of water out of the hose to wash their car. We're using a fraction of that at the car wash, and not only we're using less water, we're recapturing a lot of the water that comes off the vehicle. We're letting it settle and we're reusing that water multiple times. So from an environmental perspective, we're very focused on these being both efficient and friendly. And I think that's an important part of the story. We want to use the latest and newest technology. The chemical composition is really important to make sure you get a very high quality wash without using more water or more chemicals that are necessary. Having the latest and greatest technology on the tunnel equipment itself, is also important to make sure that the process is efficient. And ultimately, we think we're going to deliver the highest quality car wash in the industry. That's our goal, to be known for the quality of our car wash and our customer service. Those are the tenets, the underlying tenets of the Aquasonic brand.
And accelerated depreciation benefits for investors. Does this apply here?
Yes. So the tax laws are changing and evolving, and we always ask everybody to seek their own independent tax advice. But under the current tax code this year, you are with certain assets, which include the equipment that we use in the car wash, and potentially large pieces of the cost of actually building the buildings are allowed to depreciate 100% of the value of those items in the first year. This gets reduced under the current tax scheme to 80% next year, and then we'll go to 60% the year after. But thinking about the equipment, for example, the equipment alone is a $2 million package, roughly order of magnitude per site. That equipment package has a 5-year or so useful life. So even if you're depreciating the first 80% in year one and the last 20% over the next 4 years, you are depreciating 100% of that up front and quickly. So or 100% over the life and 80% upfront and quickly. So to the extent that investors have other taxable gains that they'd like to shield with a non-cash loss on the depreciation side, of course that depreciation gets recaptured at exit. But it does, if investors have significant other gains, there is a good shield there. And that may expand beyond just the equipment side. It could expand into the building side, and the numbers could get more meaningful.
I have questions coming from all around. So when do you anticipate the 2 initial sites to come online?
So it's about a 1-year process from land acquisition through the sort of the soft cost, the planning work that has to be done before the shovel can go in the ground. So there's about 6 months of soft cost, design, engineering, approval, permitting, and then there's 6 months of construction. So it's about 12 months from land acquisition to grand store opening or store grand opening. And of course, that's going to vary slightly by municipality, given their process. I would say that our view today is Orlando in Orange County, where our site on Curry Ford Road is located, has an expedited process that skips the site plan approval process. You go right to building permits. So that may save us 2 to 3 months up front. So that might be a 9 or 10 month land acquisition to grand opening store, whereas Tampa's a little bit longer. It's 12 months. So we factor in a year from land acquisition to opening.
Why are you exiting your existing car wash businesses and not converting them to this model?
So we entered the car wash business with a very different model. And again, as I mentioned earlier, very different circumstances in the market. At the time, and this was late 2019, we were able to acquire existing car washes and renovate them and have a basis that was a fraction of a brand new car wash. So we felt that that was a better way to get into the business from a basis perspective. Since we got into the business, a couple of things have happened. The first is valuations have gone through the roof. So buying an existing car wash is now much more expensive, than building. The multiple, we were buying at 5 to 6 times in place EBITDA, and now today that's 9 to 12 times EBITDA, and you saw some of the EBITDA multiples for portfolios on those transactions I shared earlier. So the valuation metrics have changed dramatically. And the second thing we've realized is we've learned a lot about the business and what makes for a site a successful site, and things like what the minimum traffic needs to be, and what the size of the site needs to be, and what kind of circulation is required to really drive the volume. And so we've factored all of this into our planning and made the decision that we'd rather buy greenfield sites that are larger sites that allow for a sort of our prototypical product to be designed. And we think that's a much better path forward to getting to scale and to getting to a meaningful business than buying existing infill, that are on maybe, the B road versus the A road. The site's a little small, it's tight. You can only have 3 vacuums instead of 20, whatever those different constraints are. So we've pivoted with the market and our learnings, and really believe this is the best opportunity going forward in the business.
And someone is asking about contact info. We will send that in an email to all of you in 24 hours, which is exactly tomorrow at 11. And if you'd have any questions, you can always reach out to us. Why express wash? Why not flex or full service, really?
Yeah, as Ian touched on earlier, the benefit of the express versus the flex and the full is really labor savings. We can run an express store, really with 2 or 3 employees, versus if you were full serve and you were manually cleaning the inside of cars, you need a lot of people to do that. It's often difficult to predict, and we've tried it, so we know these things from experience. But it's often difficult to predict the demand, and you have people standing around at the wrong times and not enough people at the right times. And it just makes for a very difficult model from a labor cost perspective. And so that's why we've chosen not the full serve. And I think people today also want more convenience. So there are certainly markets where full serves do very well. They're in the right locations with the right base of customers. But we think the larger market opportunity is with people looking for convenience. And as I said at the beginning, if you don't want to vacuum and it isn't busy, and as you could see in our diagrams, we had 3 pay stations, and circulation and flow through the site is critically important. You can be through the tunnel in 3 minutes. So coming into the site, getting through the pay station, getting through the tunnel, and being on your way, that's 5 minutes or less, like going to the gas station. So you can do it. You don't have to plan to go to the car wash. You can be driving home and decide to stop in. We think that's a much bigger market than somebody's going to go to the car wash and sit in a waiting room for 30 minutes while somebody cleans the inside of their car. So it's both the market size and convenience, as well as the cost structure.
And why ground up?
As I said before, so that our basis at the end of the day, even on an expensive parcel of land. So I gave the example before of roughly $8 million of total cost. That's a very expensive parcel of land and a very robust equipment package. So typically we'll probably be slightly less than that. Our North 56 site we're buying for under $1 million. So that changes the dynamics pretty quickly. But the quality of the product we can have doing ground up versus buying an existing that, again, may not be on the right site, may not be big enough, the layout may be constrained, it's much more complicated. And I liken it to anybody who's done a renovation or an expansion of your house. It always seems like it's easy. We'll just add a couple 100 square feet on the back of the house. By the time you get into tying in the plumbing systems and the floor and the grain and the woods, and it's much more complicated than just starting from scratch. And so, again, we think that's the wisest, and the easiest path to getting to scale.
And since we have a couple of more minutes, why the strong interest in car wash as opposed to traditional asset classes?
Another great question. I mean, the other asset class that we've historically invested heavily in, as Ian mentioned earlier, is the multifamily side. We've acquired and now disposed of over 3,500 units, of apartments across the U.S. And that's a product and an investment asset class and a strategy that we are really enthusiastic about and have done incredibly well in. But valuations are at an all-time high. Cost of debt is very high. There are a lot of economic headwinds. So we just think valuations there will be coming down. And it's not the right time to be buying multifamily today. And there are similar stories around other asset classes. Each one has its own specifics, but valuations are high, economic headwinds, and our experience both from operating, but also a lot of the research we've done really indicates that the car wash industry is very early in its development. There are tremendous opportunities. It's internet resistant. You can't buy a car wash, or have a car wash done. You can buy a car wash, but you can't have your car washed online. And it tends to be very resilient in periods of low economic activity. So it's not recession proof, but it's recession resilient and strong through those periods. And it also applies to the entire marketplace. There's a large chunk, a large portion of the population where their car is their most valuable asset. And so it's something that they have a lot of pride in, but they also have a legitimate reason to take good care of it as their most valuable asset. So we think there are a lot of reasons that will support the strength of the industry through any economic hiccups that we experience here over the next 12, 18 months, however long we do.
Let me just add to that, Gareth, as well. Sorry, let me just add to that as well. So if you think of the capital stack that we've got here, because we're financing so much of it through a sell and lease back to the REITs and on the equipment, effectively the amount of equity we're talking about per car wash is only around $3.5 million, depending on the precise site. But if you think about it, you've then got a business with that $3.5 million on, which may well have a 2 to 3 million of revenue with a 40s EBITDA. So you can see the amount of cash that's starting to flow from the investment over that period of time to service that or to repay or to provide a dividend on that equity. And at the end, you're going to be selling these again, depending on performance, you're going to be selling these at what we think are conservative EBITDA multiples of really anywhere from 12 to probably 18 million per site. So that 3 million of equity that's going in is, has a huge amount of headroom over it. So to your question, Denny, why are we doing ground up development versus buying other assets? It's because of that spread. There's so much safety margin that's built in that it just makes the returns far more attractive when we modeled it. And the second thing I'd just say as well, just to the exit point, and we know this from the conversations we're having with some of our investors who are the large capital allocators, the well-known names that everybody on the call would be familiar with, we're having direct dialogue with them. They are desperate for platforms. So what they really want is a group with probably 10 to 20 sites that they can then come in, acquire, and provide growth capital to really grow these things out to 100, 200, 300, 400 units, a la Mr. Car Wash. And so we know at the moment the shortage is not capital. The shortage in the market is platforms that this capital can invest into. So the opportunity really here is to get a small portfolio. Garrett mentions 100 or more. Yeah, ultimately, yes. But actually, you can easily see an exit here that's probably at 10 to 20 stores because of the amount of, of 10-ton gorillas who really want to get into the space but want competent, well-managed platforms to invest in.
And maybe a last question coming here is, are you able to provide, based on your financing discussions, generally where you're seeing cap rates, equipment financing rates at in the current market? Have you seen a shift in the market recently?
Yeah, another good question. Yeah, cap rates are definitely moving around and have expanded a bit since we started having discussions. So our deal on our first 5 car washes with our triple net provider is at a 7.95% yield on the costs that they are funding. I would say that that's probably 75 to 100 basis points above where they were this time last year. And that's for an institution who's coming in and committing the development dollars, and then we'll hold the 30-year ground lease. If we were to build these with cash and then take them to the sale leaseback market once the stores were operating and completed, those yields have been as low as 5.5%, and maybe now we're in the low 6s. And again, that may be fueled in large part by the accelerated depreciation that the underlying purchaser can take. But cap rates have moved out, call it 50 to 75, maybe even 100 basis points, on the sale leaseback financing. I would say on the equipment financing, it's probably a similar, expansion, given what's happened in the debt markets. So, the cost of that financing has gone up slightly. But again, just given the capital structure overall of the deal, it has a very de minimis impact on the value and the returns.
Great. So I wanted to thank you both. We had loads of questions here. Anything else you'd like to add at this point? Of course, as I've mentioned, this is recorded and will be sent to everybody, including your contact information. Anything else you'd like to add?
All right, I guess just a thank you to those who have participated, and to the extent that there is interest in learning more, please reach out to us directly with the information that Denny and the team will provide, and we'd be happy to have a further conversation about the opportunity. We are looking to get our commitments in place, hopefully a number of them by the end of the year, as we have our initial closings coming up in January. We recognize that the year gets short here very quickly, but we're available to talk further about it at folks' convenience.
Thank you. And I will just say to everybody here, we are almost at the end of a great year for us here. We have 3 online sessions coming, but we're done with our conferences this year. The last one was held 2 days ago here in Miami. The Miami-Dade mayor was here, and many others. And next year, oh my God, next year, guys, you can catch us at our annual conferences in Miami, Houston, Dallas, Chicago, New York, Vancouver, Montreal, Toronto, London, Tel Aviv, Abu Dhabi, Dubai, LA, and Calgary. Coming next really is our 2-day conference in Abu Dhabi on the 24th of January. And here in the US, we are in March, first week, I believe, of March. We're doing both our Houston and Dallas conferences. And New York City is also in March. Thank you, everybody, for being here. And hopefully we'll see you at our conferences as well, Gareth and Ian, and enjoy the weekend. Thank you, everybody.
Appreciate the time.
Thank you.
Thank you. Bye-bye.
Bye.